Hello everyone and welcome to your Glassnode video report for week 31, 2022. Now, we've got a little bit of a lift off the bottom for both Bitcoin and Ethereum. We've seen some reasonable price action, which is a nice relief. Considering we've been coming off some very oversold conditions, it is nice to see. And really now the question turns to, is this a bear market rally, or do we genuinely have the fundamentals following through? So this is something that you may have seen as we come into the November-October all-time high. What we had was a peak we had a peak in prices. We hit all-time highs. But what we didn't have was a follow through specifically on the on-chain activity front. And this is a really important concept that I want to explore in this session. We're going to look at it from both the Bitcoin and the Ethereum side and really explore what this means in terms of the on-chain activity front so you can understand what's going on, whether the fundamentals support it or if this has more probability of being a bear market rally. So as I mentioned, we are coming off some extremely oversold conditions. Almost all of our macro oscillators, hodler behavior, mining capitulation, liquidations, we had pretty much every checklist you could probably ask for any kind of bottom formation. Now, obviously, markets are complex beasts. No one can actually predict the future. And what we can really do is just look at the behavior of what's actually happening to see whether this is a sustainable rally. So what we're going to look at today is specifically on the on-chain activity side. We're going to note how some of the metrics are really describing a little bit lackluster. We don't yet have what I would call the follow-through to kind of give that higher degree of confidence that this rally is fundamentally driven rather than more of an overstretched price reaction. So we're just trying to explore these different concepts. We're going to look specifically into the fee market for both of these assets and really explore what that means. And it's a bit different for both of these assets. Bitcoin has a particular fee market. Its block model and the way that SegWit works is slightly different. When we look at the Ethereum side, we're seeing gas fees down there at multi-year lows, and the EIP burn rate, the amount of ETH being burnt from those mined blocks and gas fees, is at an all-time low. So the burning rate is actually an all-time low, even though gas fees aren't. And we'll close out by looking at Bitcoin and Ethereum SOPR, which are two of my favorite metrics for actually tracking the recovery coming out of a bear market. And we're going to be using a series of alerts along the way to really try and build confidence. When a number of these alerts trigger off, we can start to build a picture that we may well have a recovery that is genuine, and we actually have the follow through from the network. Whereas if we don't get those actually triggering off, it may signal that this is more of a price rally rather than a fundamentals driven rally. Now, we did release a report last week and a video report alongside CoinMarketCap, and there is a discount code associated with this on advanced yearly subscriptions. So you can use code CMCGN at checkout. That will give you 1 month free. And do be sure to check out both the written report that we did, you'll find in the description below, and a link to the video that we did last week. And that's really just kind of help you understand how these tools are working. Try and put some of these things we talk about on these weekly videos to practice. As always, you can ask me questions in the comments if you have any queries about how to use these tools. I'm more than happy to help you along the way. So do let me know if you have any questions on that front. So with that said, let's get started. So starting out with our price action, you can see here that at the moment we are in the process of rallying. We did have about a 5.5% rally for Bitcoin on the week and about a 7.6% rally for Ethereum on a closing basis. But you can see that we are still within what you would kind of consider a bit of a bear flag. Now, remember, all bear flags and all bear markets eventually end when the market decides to break the other direction. So just because it resembles a bear flag doesn't necessarily mean that's the way it's going to break down. And this is really where we want to bring in the on-chain side of things to try and add that fundamental basis to what we're seeing in the price action. So we're going to start with a really simple model, which is active addresses. And the way to think about this, it's almost on the scale of active users. Now, the exact number of users can vary because each user can have multiple addresses. Exchanges, for example, have tens of thousands to millions of addresses. Individuals may have a lot fewer than that, but it's obviously not one-to-one. But overall, what we tend to see is when we look at this on an entities basis or an addresses basis, we get fairly similar structure. So we can still draw similar conclusions from this. Now, what I want to highlight is we can see during the 2021 and 22 bull market, we really had this very strong impulse higher in overall active addresses. We can see it here in 2017 as well. These large impulses higher, it really shows that when we have a bull market and it's all the rage, we do have an increase in in users coming into the system. The network is in general much more active. Now, note that after the 2017 top, as we came into 2018, note the rapid collapse. This massive decline is really one of the quintessential signals that a bull market has most likely ended. We can see it here as well in May 2021, a absolute collapse. And you can see we never quite recovered. Even at the all-time high here in October and November, we didn't even get close. This is what we would consider a bearish divergence. We have a higher high in prices, but the amount of activity that followed through was substantially less. This is really signifying that we didn't have the momentum to really kick this thing off. And in that case, it's why I generally argue that the bear market started back here in May 2021, because quite clearly, psychologically, the market changed. Now, also note the 2019 rally, where we had our capitulation low, we had a boost of overall activity. So this is really what ended the bear market. We had a boost of activity, and then we really traded sideways to down. It was kind of this big flag that then broke out into an uptrend. Now, here we are in our current market. We had a very similar collapse. We had that initial recovery, and we've since been really trending sideways to slightly down. Now, what this really tells us, this bear market, if we call it from going since May 2021, that's now well and truly over a year. And what we're looking at here is a pretty stable and sustained group of hodlers. Really, the people who are still in this market are more than likely going to be those higher conviction investors. We're maintaining this level of activity that seems to be sticking around. Now, what we don't have is in the very immediate term, a strong push higher. We saw a large push higher during the lunar collapse. This is a big panic event. We haven't seen that yet. So what I would recommend is for active addresses, some kind of alert breaking above about 950,000 per day would be a rough level. That would pretty much get us up to the top end of this particular range. And if we can get that on a 14-day basis, it's starting to look like we may be bouncing from a higher low and actually giving them a bit more momentum and more people coming into the network. It's getting more activity, and that generally is a good sign. So at the moment, we don't yet have it. So being a little bit cautious of this rally would make sense, but looking for that significant break higher in active addresses would be a very, very strong signal we may have support coming through. Now we can see a similar thing when we look at the transaction rate. This is essentially the transactions per second. Now what this particular metric will do, it will benefit from efficiency gains. So when you can literally fit more transactions into a block, which SegWit does allow, therefore you can actually have a faster TPS. Now, having a high TPS is not the most important thing. We won't go down that rabbit hole, but that is, generally speaking, the higher the TPS, the more data a network is putting through. Generally, the more scalable it is, but the less decentralized the nodes must be. So there's a trade-off between decentralization and throughput, or transactions per second. Nevertheless, we can see a very, very similar trend. Note this, a general recovery in overall transactions, and then we started to move into this 2019 phase of this big sideways consolidation. Now, what's quite interesting is note how, unlike active addresses, this one really plateaued all the way through 2020. And then you can see that we had our initial collapse as we had the May sell-off. We bounced very similar, but note how overall this entire metric is trending lower. Now, what's going on here? Because when we actually look at many metrics in terms of Bitcoin user profiles, there are far more users of Bitcoin now than there was back in 2019. So what explains this difference in transaction rate? This is actually being driven by technological change. We have things like SegWit adoption, which we'll touch on in a second, but particularly from 2020 onwards, many exchanges started employing something called transaction batching. So rather than every individual customer's withdrawal being a single transaction, what they now do, if you've ever withdrawn from an exchange, you may see that your withdrawal is actually part of a much bigger transaction where they process many customers at the same time, generally on some kind of schedule. Now, because exchanges represent about 40% of all blockchain consumption for Bitcoin, what we're essentially seeing here is a more efficient chain. The exchanges in particular are using the blockchain with fewer transactions, but more efficiency. And then you couple that with SegWit adoption as well. And that's why this particular metric, even though it's not at the same level, it has the same market structure, but at the moment it is trading at a lower level, actually suggesting an efficiency gain rather than a necessary fundamental shift. So just one of those interesting dynamics that's important to keep track of. Now, one metric that is particularly good at discerning between bulls and bears is transaction fees. So this is the total number of BTC paid to miners in fees per day. And you can see very clearly, here's the 2017 hype phase. This is where people are desperate to get their transactions confirmed. We're seeing increasing congestion in the blockchain, and generally speaking, congestion in the chain is one of those most important things to pay attention to that signals a higher degree of demand. We can see again, we got a lift off following March 2020, a very notable uplift for a sustained period of higher congestion and higher fees. Here's 2019, much the same trend. Now, during bear markets, note how we generally have very, very low fees. It's kind of this stable baseline. Here we are back here in 2021 and 22. We've pretty much been on this baseline. Now, there is a tiny bit of an uptick. We have been much higher since the lunar sell-off than we have previously. That's a good sign. It shows that there's a little bit more activity than there was. It may signal we're getting closer to the end of the bear than to the beginning. But what we also haven't yet seen is this upwards trajectory over a longer period of time. Now, in terms of an alert idea, if we do manage to break above about 35 BTC per day, we're currently sitting at about half that, about 17. If we do get up above that 35, it would probably suggest we're getting to the upper end, and on a 14-day moving average, that's going to give us a bit of confidence that we actually may have increasing congestion. And if we combine that with our transaction rate and our active addresses, we could start to really see follow through from those users coming in on chain. Now, to really highlight this concept, this is again a little bit more technical, looking at the way that Bitcoin blockchain and how its actual structure works. Now, what we're looking at here is the average block size in terms of bytes. So you can see here, note here through the 2020 and 21 phase, we were up around 1.3 to 1.5 megabyte blocks. That was a typical size. And we note here that during that same period, we had high congestion. So the blocks were full during this time. Now, also note, this here is SegWit adoption. Now, what SegWit does is it basically splits between the witness signature and the actual data footprint. For the layman, what it really means is that the block can actually handle more transactions per second. It's essentially allowing more transactions to fit in per block. So the way to think about this is the block has more capacity. We can literally fit more into it when SegWit adoption is high. Now, prior to around June 2021, SegWit adoption was around 55%. Now, there was a very, very large scale shift in SegWit adoption. Some of the large wallet providers that have a very, very large amount of Bitcoin wallets started to implement SegWit by default. And this then jumped up to around 70 to 85%. So a much, much larger adoption. Therefore, we should be able to fit more into a block. Now, here we are at 1.3 to 1.35 before that upgrade. So we've got 1.3 megabytes per block. And here we are hovering around 1.2 to 1.1. So what's interesting here is we can fit more. We should be getting up to about 1.5 or 1.6 megabytes, but we're not. We're down here at 1.2 to 1.1. Now, what's going on here is we actually have relatively empty blocks. They're partially empty. They're not full to the brim, and that's then reflected in our fee market. So really what we want to see, if we want to confirm that we have Bitcoin activity really picking up, we want to see active addresses climbing. We want to see transaction fees really climbing on a sustained basis. And we want to see the mean block size ticking much higher than around 1.3, 1.35 megabytes. We want to see it really starting to climb. If we get all three of those, it's starting to signal we have genuine inflowing demand and the network is becoming increasingly highly utilized. Until that point, it's more of a price-driven rally. We're not seeing that influx of new users. We're not seeing that influx of attention that we typically see at the start of these bullish trends. On a more positive note, Lightning Network capacity in public channels, this is the amount of liquidity that's available to be sent around the Lightning Network and really is a great measure for network effects. We have pushed again to another all-time high, up over 4,400 BTC in total capacity. Now, this is still growing even within the bear. You can actually see it's growing even more as prices get lower. This is a sign of genuine and very, very real network adoption. There are no token incentives for the Bitcoin Lightning Network. So really, this is truly organic growth in terms of capacity and people actually opening channels. There are no subsidies or invested funds trying to actually get these numbers to move higher. So this is actually a truly organic and quite a constructive and positive thing to see. So even though we don't have the activity necessarily growing as much as we generally see at the start of a bull market in the on-chain space, Lightning Network continues to impress, pushing up to all-time highs in overall capacity. This is an excellent sign, and it is what we want to see for growing network effects. Now, coming across to the Ethereum side, we have many of the similar topics, but I want to kind of touch on this with the nuance specifically around Ethereum, just so you understand some of the dynamics about what's going on. Now, in a very, very similar way, we do have a downtrend going on in overall transaction counts. Now, I have a 14-day moving average here, and you may see this burst of activity, and you may say, well, that actually is quite different. It may well look quite healthy. But what I want to do here is actually jump up to our settings, and I want to turn this moving average off back down to 0 days. And what you can see is that this was an individual day. What this looks like, and it showed up on active addresses as well, was an individual exchange that was doing a very, very large wallet consolidation. So generally speaking, exchanges will only do these wallet consolidations in very, very low fee environments because they don't really want to consolidate all of these addresses when fees are high because it will cost them a huge amount. So what this actually may signal is we probably have a very, very low fee environment when we see this type of behavior. So if we actually jump down and have a look, what we have plotted out here in the green curve is the total amount of gas. Think about like the block size capacity. This is the total amount of gas that can be put inside each block. The red curve is the amount that miners are actually putting in, so the actual usage. And you can see that it typically climbs up. And when they do when the miners increase the block size, which they can do in Ethereum, they can't do in Bitcoin. So that's one difference between these two networks. You can see that the amount of gas that can fit in continues to increase. Now you can see up here at this top zone that they're pretty much one-to-one. In fact, the amount of usage of Ethereum block space is about 99% plus, very, very consistently. So Ethereum blocks, unlike Bitcoin blocks, are almost always full. And yet before, we saw that we had the exchange doing a very, very large wallet consolidation, which would indicate low fees. So that's what this blue curve is showing. This is the median gas price paid. So you can think, you may have seen this in terms of GWEI. We have seen for a period of time over 100. These big spikes here are over 100 GWEI per transaction. These were when we were getting $5, $10, $15, $50 gas fees, sometimes even for very simple transfers. So you can see that even though we have full blocks up here, we have a decline in overall gas fees. And actually, if you look at the gas price, we have to go back to May 2020. When the price was $220 to actually find an equivalent level of gas fees. So you can see that even though the blocks are full, people are paying less and less and less to actually get their transaction confirmed. So we're seeing that congestion is actually coming down to multi-year lows. So even though Ethereum has had very, very strong price action, getting up above $1,700, we actually don't have the amount of inflowing usage. The blockchain is actually being used less than it was before that. So again, it's starting to suggest that maybe this rally doesn't yet have the fundamentals following through. And this is where we touch on EIP1559. So in this case of Ethereum, low gas fees actually have an implication on the supply side. So the chart that we have plotted out here in red, this is the deflationary threshold. This is showing when the issuance coming out from miners is being surpassed. When the blue curve is above the red curve, it means that Ethereum supply was deflationary. In that particular set of blocks, miners were burning more ETH than they were issuing. So overall, the ETH supply actually declines. Anytime that the blue curve is under the red curve, it's showing that we have an inflationary supply. We are seeing that there is more ETH being issued than burned. Now, where we are at the moment, this is where we're at all-time lows. It's actually broken even lower overnight. We're at 10.8% of issuance being burned. Now, previously over here, we were burning 40% of issuance, 50% of issuance, 115% of issuance. So you can see here that we're actually burning substantially less ETH than we have in previous months. So what we're really seeing is that even though markets were very oversold recently, we actually have a period where both Bitcoin and Ethereum are the least congested they've been in a very, very long time. And this is just something to be very aware of, that we don't yet have the activity coming in to really justify and kind of support what we saw in this rally. Now, that doesn't mean that this rally can't carry on, because the market moves into a more risk-on sentiment, and may well that be the time that people actually do come in. They see the price going up, and then we get that influx of users. And this is why alerts using these tools are actually quite powerful to try and spot when multiple of these different metrics are all starting to achieve escape velocity at the same time. Now, the very last metric that I want to touch on is one of my favorites. This is the SOPR metric. It stands for Spent Output Profit Ratio. So the way to think about this, higher values means that on average, all of the coins being spent are realizing a higher profit. So if this is reading 1.2, it means that overall the market is realizing 20% gains on average. When we see these low values below 1, if it's signaling 0.8, that means that on average, people are realizing a 20% loss. Now, what we can see is that we've been in this loss-making regime for an extended period of time. It looks much the same as we had here in May, June, July. And you can see that this really looks like a major capitulation event, particularly here on the 18th of June. Now, what I want to look for is, generally speaking, in a bear market, a value of 1 will be resistance. And this is because people are selling at their cost basis. Get me my money out at any cost. I just want to get my money back. So people will sell at their cost basis. They will then go through a capitulation phase. We have to generally test that multiple times before we finally break and get escape velocity. And here's Bitcoin attempting yet another break above. So what we want to see in a constructive sense is a break above 1. And generally speaking, we want to see it come back and retest that level. Here's a beautiful example at September. This rally into a pullback, beautiful retest, and then bouncing away it goes. These are people buying their cost basis, seeing that there's actually value. So in a bull market, a SOPR value of 1 typically acts as support. During a bear market, it typically acts as resistance. And it's that psychological level of people buying or selling their cost basis respectively. So what we really want to see is Bitcoin's SOPR break above 1 convincingly. That means the market has absorbed the profit taking. We want to see it come back, retest that level, and then bounce again. And again, when we combine that observation, if we do happen to get that with a follow through of the on-chain activity, that would be a really, really strong signal that we really do have profits being realized, demand coming back in, and a thumbs up for a more sustained rally. At the moment, we're kind of at the cusp of the market needs to prove that it wants to go higher and actually break through many of these metrics and see that follow through. We haven't got it yet, but this is certainly something to be paying attention to. So a Bitcoin SOPR break above 1 would be a good alert to set to just really pay attention to it. And again, if you get that alongside all these on-chain activity ones flagging, that would be a pretty good sign. And on the Ethereum side, it's had a little bit more luck. It has broken up above a value of 1. However, one thing to note is that Ethereum does tend to actually go on these excursions above 1. This is partly because the blockchain is a little bit more nuanced than Bitcoin. You've got all of the DeFi applications. People who are moving their coins don't necessarily have to be spending them. They may be moving to a new wallet so that they can perform a DeFi function or use it as collateral. So we do tend to see these excursions above 1, which then fail and get pulled back below. We can see multiple of these during this bearish trend here in May, June, July. We can see multiple of them. This was a big one just before the lunar collapse, where we saw a big excursion that then got hauled back under in a very, very significant way. So right now we have broken above a value of 1. What I've got here as an alert idea is actually to pay attention to if we break back below, because that would be a signal that we perhaps have some market weakness starting to come in. And perhaps that this rally actually doesn't have the momentum that we think it does, and therefore it would be a sign to be more cautious. So thanks for tuning in for that session, folks. Hopefully you've got some tools there to help you navigate the next couple of weeks. We don't yet have the on-chain follow through, and that's okay because sometimes price will bring that. Sometimes price must lead and then the activity follows. But as we saw in October and November, if we just don't get the follow through, it does pay off to just be a little bit more cautious because we don't have the fundamentals on either blockchain really supporting it just yet. So I've gone through a series of alerts, particularly SOPR and the on-chain activity side. These are ones that I'm paying attention to and just watching for if those happen to trigger off. And particularly if you get them triggering off in combination, you want multiple things telling you the same story. So hopefully that's useful, and I'll see you in the next week. Cheers.